Hello and welcome to a brand new show of Market Makers. Indian markets, they continue to move from strength to strength. Even though the local news flow has dried up, everyone is crying that there are lack of triggers. The global tailwind is so strong that Indian markets continue to surprise us on a daily basis. For the moment, crude flows and global economic data are on our side. So how should one read into the current market setup? Nifty is already up more than 25% this year. Are there still bargains left in this market? And how should one put capital to work? To discuss that, Ravi Dharmashi is back. Ravi, good to have you back. Thank you for joining us.
Thanks, Nikunj.
We can endlessly cry about there are no local cues. There is nothing which has come from the new government so far, but that is not changing the market behavior. Markets are sitting at a record high.
Yeah, Nikunj, thanks for having me. It's been a year since I first appeared on your show, and it's been a wonderful year. I guess somewhere the good luck charm is working. No, you're right that in the short term, markets have run up. It's been a wonderful journey, and the obvious triggers or the catalysts that market keeps looking for are missing to some extent, the big bang reforms. But the underlying, the smaller steps, the on the ground feel has changed for the better for sure. Earlier on, this started out as a rally where it was more coming back to normal, back to business kind of a thing. But now the potential as we look forward looks brighter and brighter. So you are right, there is always a risk of a correction at any point of time. But I still believe that the higher risk is of missing out on the equities rather than of having a temporary dip.
So let me take the clock back. Let me take the clock 1 year back. A year ago, there was a feeling of mortuary. Everyone had written off the India story. Rupee had plunged to a record low. Twin deficits were alarming. But now there is a feeling of carnival. And the problem with this carnival feeling is that hope is back. And that's always a dangerous thing.
Hope definitely is back. But I don't think there is a carnival except maybe in the studios. On the street, the people are waiting for a dip. Since last few months, there have been positive inflows into domestic mutual fund. But I believe that is only a beginning of a trend. For 5 years, there have been constantly outflows from retail investors. As long as there is no crisis unfolding in the world anywhere, I do not see any reason to be overly concerned about any such thing.
Ravi, we may look at Indian markets and feel happy that we are finally outperforming regional markets. We are the best one in the league. Last year, same time, we were considered to be the weakest link of the fragile five. So how much of the current market action or market activity is largely global in nature? Because as we speak, it's not only India. Other markets are also sitting at a record high.
You're absolutely right. Sitting in the pond, we feel that we are at a record high and we are in uncharted territory. But look at Brazil. It's performed. I mean, it's given a 30% return in a matter of few months.
Even though crude has gone down.
Even though crude has gone down, and they do not have the Modi effect. Yeah. So I wouldn't say that we are way out of our league in the performance that we have shown. It's a good performance. It's in sync with markets have been very discerning. Post the election result day, the PSUs, the cap codes, the real estate stocks, they were not performed. They were in fact marginally negative, I believe. So you can see that despite the nomenclature of defensives being given to the IT and pharma, wherever there is visibility of earnings are the only stocks that are performing.
And that was your call, that you said, look, I would gravitate my portfolio towards IT and pharma because that's where I see a lot of visibility. And for the moment, markets are lapping up IT and pharma stocks as if there is no tomorrow.
Yeah, so there were few months in between, just prior to the election result, where the beta really took a major bump up as compared to the IT and pharma. But had we changed the entire portfolio to align for that view, then we would have underperformed in the next few months. But we always go for alpha rather than going for cyclicals and beta. We focus on bottom-up stories. Even if we come across a good story in the cyclicals, it would still be a bottom-up story. And we are still of the view that yes, the valuations are much more attractive in the cyclicals and PSUs. but the alpha or the certainty of returns is higher on the IT, pharma, financials, FMCG.
So focus on stability rather than trying to weave your portfolio around some assumptions. Now, core of your portfolio is still IT, pharma, and financials. So I'm going to walk, I'm going to request you to walk me through all the key sectors. Let's start with IT. Some would argue that IT is a crowded trade. IT as a cluster, IT as a clan has managed to outperform Indian markets for 3 or 4 years in a row. Can IT still outperform Indian markets? TCS is now sitting on a market cap of 5 lakh crore.
So IT, CNX IT has a P multiple of approximately 20, and Nifty has a P multiple of 18.5. I don't think there's significant overvaluation in IT, and you have to look at TCS in the context of the Cognizant, IBM, Accentures of the world.
Those are different companies.
Right,
that's
but
a different market.
Our business model is better. We are offshored. Our margins are better. Growth profile is better. And we are finally taking away their market share. Indians have reached at about, if I'm not wrong, 6% market share in the global IT outsourcing market.
Have a long way to go.
And so there is 15% to 17% growth compounded over a 3-4 year period with stability in margins. I don't see an issue of maintaining the valuations.
You liked Tech Mahindra for the longest time, more than a year for sure.
Yeah.
Do you still like Tech Mahindra? The Q1 numbers were not impressive. Margins contracted, attrition rates, they went up. The management is confident of a bounce back, but they did not commit to a timeline.
So Tech Mahindra, our entry point was fantastic when there were lots of ifs and buts about the stability of the business model, the growth coming back. Now at this point of time, I agree with you, the performance has to keep coming in for the valuations to be maintained. But we believe that it is a worthy company to be in the top 5 in India, and sooner or later it will diversify from being telecom heavy to telecom and BFSI kind of a business model. So if the delivery on the growth continues, I don't think it's going to be an issue maintaining valuation.
Are valuations on your side as an investor if you buy into Tech Mahindra now?
They are less so than they were earlier, but I don't think you can still make an absolute returns going forward from here.
What do you mean by absolute returns?
So 15-20% compounding is what you should expect.
Do you think Tech Mahindra could be part of your core portfolio for next 3 or 5 years? Is it a stock which you're happy to buy right now and not look at it for next 3 years? Are you confident of that are you confident of that degree of earning delivery from Tech Mahindra?
So it's a hypothetical question for me. I am already invested, but if you ask me,
first timer, for someone who's watching the show,
I would definitely buy and hold on, and I have no problem if there is a dip in between, I can add more. That is the way I would reduce my cost. But I don't know if there is going to be a dip or no.
Anything else apart from Tech Mahindra which appeals to you even after the recent run-up? Because now to find out a stock which has not run up in such a strong roaring bull market would be impossible.
So we have changed our portfolio strategy to buying good companies that are going through bad times in recent run-up. So one of the such company in the IT or ITES kind of sector is eClerx. It has been a core holding earlier as well, and we have bought more. The company is going through a lean patch where it is growing 10-12%, but the margins and the ratios remain strong, and we believe that there is a light at the end of the tunnel sooner rather than later for eClerx.
What is the challenge for eClerx? I mean, their business model was robust, but margins are contracting. Is the core business, which is a KPO business for eClerx, is that coming under pressure? Do you think competition has intensified there?
See, more than competition, because they are concept sellers, it is difficult to convert a new client. They interact with the CXOs of a old world kind of a company. Okay. And it is difficult to change their mindset to outsource. If you are interacting with a CXO in a technology organization, they are more. It's easier to convert them to outsource or offshore their work. So for them, the challenge is finding new verticals, which they have successfully done by getting into cable. one acquisition, Agilist, which they have beautifully ramped up. But now they need their other two engines to fire as well, which is BFSI and retail.
You own names like Aurobindo Pharma, Natco Pharma. You've bought these stocks at the right price. They've been great, return ideas. Are you still happy to own Natco Pharma and Aurobindo Pharma for next 2-3 years?
Absolutely.
Aurobindo Pharma has gone from 150 to 700 to 800 actually.
Yeah. So let me start with Aurobindo. Aurobindo, there are naysayers still out there. There were doubts.
Smile on your face every time you talk about Aurobindo Pharma. What price did you buy Aurobindo Pharma?
I mean, ranging from 200 to 300.
Wow. It's already been a 4x.
Yeah. So there were doubts regarding the profitability of its product portfolio. There were doubts about its ability to generate cash flows. There were doubts about its ability to repay debt, to maintain margins. So Cymbalta came in, which was supposed to be a one-off kicker, which helped them in their growth. But now there are doubts regarding sustaining of margin. The company is guiding towards 22-23% margins ex of Cymbalta, and including Actavis acquisition. And company is guiding towards a 400 crore kind of a PAT quarterly growth run rate. So given that, the FY15 earnings that we are looking at is somewhere between 50 and 55, and FY16 could be anywhere between 55 and 60. The stock is quoting at 800. That is not the multiple that a pharma company quotes at, with a $2 billion kind of a turnover.
Strong expansion, that's the story for Aurobindo Pharma.
Cash flow.
Okay, cash flow.
Cash flow. Everybody was worried that they'll end up making a big acquisition, and whatever cash flow that they have generated will get sucked into that.
They've done a great job of currency management. So I'm going to move on from Aurobindo Pharma. You've done your homework on that, so I won't challenge your thesis.
No
Marksans Pharma.
Yeah.
You bought into Marksans Pharma.
Yes, we have.
When insiders told me that you bought into Marksans Pharma, the question which came to my mind is why?
So Marksans Pharma, he's obviously Mark, who's the brother of Glenn, and he has a point to prove. The company has gone through a bad patch. They went through BIFR, and they have successfully come out of it. They sold out an API unit, and the internal cash generation helped them get out of BIFR and repay almost all their loans. I think about $5-6 million worth of FCCB are still pending, but that's besides the point. It is the fastest growing company to reach 500 crores of regulated market sales. And it is a very low risk model. It's a generic. They are not targeting some paraphors where there are going to be sudden drop in prices or anything. It's a generic. They have found their niche in soft gel. Soft gel is a little difficult to conquer technology, and because it's a small pie, not many people are focusing on it. So Marksans has found its niche, and they are using this niche to grow in this phase. Later on, I'm sure they'll evolve into getting into bigger ocean.
So I'm going to blend my follow-up question on Marksans Pharma. One, the stock has gone up from 20 to 50.
Stock has in fact gone up from 3 rupees to 50 rupees.
3 rupees to 50 rupees, and you still like it?
Yes, absolutely.
Okay. They don't have the best margins in the industry.
They are improving. The margins over the last 4 years have improved from 15-16% to nearly 19%.
Are you happy to buy Marksans even at 50 rupees?
So as a concept, and people might have that doubt, but we do not have a doubt that they will succeed. It has a potential to earn 5 rupees in FY16. If that is
a 10 PE stock.
Yeah, if that comes through, then it is a 10 PE stock. So now it depends on how confident you are that 5 rupees is coming through. We are confident.
Okay. So we've discussed two legs of your portfolio. The third leg is finance, or the financial sector, or financials. You like private banks, and that call again has worked well for you. But the challenge for some of the banks now is that they are over-owned, and they are over-owned by domestic institutional investors, foreign institutional investors, and even insurance firms. Now, banks are big companies. They've got big market capitalization. So if the institutional appetite is going to be limited because of technical factors, how will these stocks move up?
First of all, I don't think they are so overowned that there is no room for any growth. ICICI Bank, economy is just bottoming out. The expansion in the financial savings is up ahead of us, which will lead to growth. the multiples, the price to book multiples are still reasonable, and the interest rate cycle has peaked out, though it has not started coming down. So there are enough triggers over the next 3-year horizon we can foresee, which is going to lead to a re-rating in the banking stocks.
We are priced to perfection. HDFC Bank 3.5 times book, ICICI Bank 2 times book, Axis Bank little over 3 times. So I'm not debating your thesis that whether economy will bounce back or not. Economy will bounce back. Cyclical and structural healing will happen. But our market and our stock price is already capturing that.
HDFC Bank, now that you mentioned, is actually quoting at the lower end of its valuation historically. It's quoted in 3 to 5 kind of a band, and 3.5 times is on the lower side, provided you believe that they can deliver 25% plus growth. So I would eyes closed put my money in HDFC Bank.
Eyes closed.
Eyes closed, absolutely. There is no reason to be worried about valuations or economy.
They're slowing down.
It can give you subpar returns as compared to some of the high flyers, but it will give you sure returns.
But the HDFC engine, the great engine which was humming at 30% plus, that engine is slowing down.
25% is not such a slow growth. Let it go through it has gone through a few years of consolidation. It will pick up. HDFC Bank remains the best engine in banking sector, though our bet is largely on ICICI Bank due to the valuations.
Secretly, are you betting on HDFC and HDFC Bank merger?
No, that's not a part of our thesis. If it happens, great.
That's a bonus.
That's a bonus, yeah.
We've argued last time that why do you like NBFCs? But what you like within NBFC is more interesting, which is M&M Financials. And M&M Financials is going through a painful time. Their NPAs are not bottoming out. CV business in South is a problem area for them. So why are you buying into a company which for the moment is in a mess? Mess is the word.
So M&M Financials did grow very aggressively during a period when economy was slowing down, which is why these problems are cropping up now. We did a stress case analysis, and we believe even in the worst case, their credit cost can lead to a 25% kind of a profit erosion in a year. So that is, of course, definitely a bad thing. However, that is the worst case. Given that, the book value will be 90-92 for the current year, going to 110 and 130 in FY17. So if 2 quarters down the line we see the economy reviving, this is the best play available on rural economy on the financial side. Financial inclusion is the name of the game. We believe in Mahindras as a group, and M&M Finance has really strong processes in place. The moment this bad patch is over, you will not find these stocks available at this price. It is because they are going through a lean patch that you are getting it at closer to 2 times book, which has rarely been the case in M&M Finance.
That's unique about your money management style, which is that you like to buy good companies when they are going through a temporary business pause.
And we can end up overestimating their revival. It might not be 6 months down the line, it could be 1 year down the line. But we have no doubt on the company.
So patience is the key here.
Patience is the key.
Is that the logic why you bought into MCX? A great company which has gone through a terrible mess and now has a new owner.
MCX is slightly different.
Is MCX a leap of faith?
No, it is not a leap of faith.
Just because Kotak is bought into it?
We bought it before Mr. Uday Kotak bought into it, or rather Kotak Bank bought into it. So the thesis is very simple. Exchange is a super business. And if you go through the PwC audit, you will realize that if thousands of crores were passed on to FT, then it tells you how profitable the business is. Yeah. It anyway had 50% plus margin. And if you add back, it tells you how profitable the business is. MCX has gone through an existential crisis, and it has survived that. It has a new promoter. The technology agreement with FT is being revised as we speak. So, and the volumes were low due to commodities cycle being down and everything. So we are buying at roughly, at the time when we bought, it was about 2,500 crore net of cash kind of a market cap. If you are getting a leading commodity exchange with 85% kind of market share.
There's still a little bit of leap of faith.
Of course, it is a leap of faith.
You can't be sure of numbers.
But you can be sure of the valuations.
Okay.
You cannot be sure
You like
of the numbers.
business.
Absolutely. See, one more thing which not many people realize is that under FT, MCX was restricted to being a commodity exchange. With FT out, it can become a vehicle for any other kind of an exchange. Stock exchange, currency exchange, bond market, any other exchange exposure of can come under MCX. So that is a big market opening up. It doesn't have to remain an Indian commodity exchange. So the potential and the possibilities are humongous.
That's a classic way of investing. It was a good business, bad management, now a good business with a great management.
And absolutely cheap valuations. And absolutely cheap valuations.
Okay. Earlier in the show I took the clock back and I said a year ago markets were in a mess. The mood was fragile. Now mood is upbeat. Earnings will bounce back. So I'm going to take the clock forward. A year from now, when we would be recording another edition of Market Makers, where do you think markets would be? What kind of Nifty level, what kind of Sensex level do you think we could be staring at?
I wish I could give you a Nifty level, but I can tell you the portfolios will be higher. The portfolio levels will be higher. What matters to me is my Nifty and my Sensex, not the averages. So no, seriously, whether it is a 10% correction first and then a rally, or whether it is a 10% rally first and then a correction, eventually the direction is up. We are, the economy is bottoming out. We are talking to various corporates across conferences, and we are starting to get a feel that the sentiment is starting to get converted into on the ground change as well. So, and valuations are not completely out of whack. You can always have a 10% correction for whatever reason, whether it's interest rate hike in US or a crisis somewhere in Europe. But is that going to lead to a permanent damage? I doubt that. So we would use that opportunity to buy more.
It's the destination which is important, perhaps not the journey.
Yeah, so the journey can be, because it's already run up so much, we can definitely have some kind of trouble along the way. It has to be part of your hypothesis going forward.
Finally, how's your business going? Is money coming? Are
money
ready to buy into India story?
Money that was trickling in has now started gushing in. We are waiting to see it become a flow.
But as of now, there is no evidence that the average retail investor, the average HNI investor is back.
They are back. You will not believe, but I have about 60-70% of my investors telling me that as soon as I sell my piece of real estate, I am giving you money.
Okay.
So everybody is looking to sell real estate and looking to put into equity.
The real estate is not selling.
Exactly. So that is the thing. Their cash flows are stuck elsewhere.
Okay. So not only अच्छे दिन पर बहुत अच्छे दिन आने वाले हैं.
Surely for us they have.
Okay. Ravi, always a pleasure. Thank you for joining us.
Thank you so much, Nikunj.
That's it on this edition of Market Makers. Thank you for joining us. I'm Nikunj Ralmia signing off.